topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Welcome to the Ask the Expert show on W4CY Radio and Talk4 TV, where we bring you educational information from top local experts in the fields of legal, health, financial, and home improvement. Now sit back and listen to experts in family law, association law, hearing loss, business brokers, home care, along with many other topics. Now here are your hosts, Steve-O and Sophia.
Hey, good morning. Welcome to another Ask the Expert show where we bring you the top experts in the field of legal, health, financial, and home improvement. We have a great guest on this morning. He's with us twice every month with his great expertise. Let me welcome Ray Farrar. Hi, Ray.
Steve, good morning and happy Monday.
Same to you. You know, we do show prep before, but I got to ask you a question because we are getting so many people asking, knowing your show is coming on this morning. What is this war in Israel going to do to the financial market?
It's it's a bit perplexing, Steve, in a number of ways. Obviously, the tragedy of the war at a cost of human life is beyond comprehension for many of us, and the brutality that's been seen. So first of all, let's be sure to be thinking about those folks and the sadness that all of it brings. But at the moment, the markets over the past 10 days, 2 weeks, that the war began, has kind of not thought too much about it, feeling that it would be a relatively contained situation between the Palestinians and more specifically Hamas and the Israelis, and so it's been very muted, and most of the movement that we've seen in the market over that time period, which has been in a downward trajectory, has been more about interest rates going up than it has been about the war. Having said that, it's probably fair to say that if this war were to escalate, and there are some signs that is a distinct possibility, to either bring in Hezbollah from north of Israel in Lebanon, or perhaps Iran to the east of Israel, that expansion of the war is going to have a dramatic impact on the markets in the short run. The long-term effects are unlikely to disrupt the markets worldwide on a long-term basis, but in the short run, it clearly will. I mean, we've got oil issues to deal with. We could have rockets being fired at our fleet, which is there in the Mediterranean. There could be ships that are seized, which has occurred already in the Straits, where most of the oil flows. So it could spread. It could spread into the market if the war spreads, but at the moment, the market has basically said, I have other things to worry about rather than what looks like to be a contained conflict, war in Israel and in the Gaza Strip.
Well, I've noticed gas prices going down. It's funny, I say going down. I never would think about $3.19 is gas going down. But from what I understand, it's getting ready to shoot way back up again, maybe even higher than it's ever been before.
Well, clearly, as I just mentioned, the flow of oil from the Middle East has been disrupted a little bit as a result of the war that is going on there. Um, the OPEC Plus, which includes Russia, has cut back production in an effort to boost oil prices. It wasn't all that long ago that oil was selling at $60 a barrel, and today it's closer to 85. That's a pretty dramatic increase in a relatively short period of time. And that's why when measuring inflation, we think of core inflation, which excludes the volatile up and down movements of food prices and energy prices, because it can move all over the place. But clearly, prices are up, and just to point out that they'll probably come back down again and bounce around. But at the end of the day, there is a long-term trend for gasoline to move in an upward direction. As you and I joked about in the last show, we can actually remember gasoline selling at 20 cents, 25 cents a gallon, not
Yes.
$3 plus or $4 plus. And, in California, I mean, it's still up in the high $6 per gallon or $7 a gallon. So it's a very volatile industry that consumers find themselves having to pay more for that and less for those things they would like to have, which is always a concern from an investment point of view.
Oh, absolutely. Well, let's get on to show the Federal Reserve has been raising these interest rates since first quarter of 2022. What are you expecting is going to happen this next meeting this month?
Steve, the Federal Reserve, starting in March of 22, has raised interest rates about 500 basis points, or about 5%, and that they did that over 9 different times. In the last 4 meetings, they've raised rates twice, and they've paused twice, and it's unless the CPI numbers that are supposed to come out later this week are dramatically higher. Dramatically higher. I think that we're going to see the Fed pause coming up at their meeting early next month. But I don't rule out the possibility that they'll raise rates one more time in December before the year is out, once they see the results and the effects of what they've done already. Right now, with interest long-term, the Fed controls short-term interest rates. Right. The long-term interest rates are controlled by the market. And over the past month or so, the price of bonds has declined dramatically as the interest rate has risen equally dramatically on the longer end of the bond curve. This morning, for the second time in a week, the 10-year Treasury touched 5%. And when people are weighing 5% guaranteed versus the volatility that exists in the stock market today, there's a huge tendency to stay with that 5%, which means that if people aren't investing in the stock market, we're going to see a lot of volatility there, which means if it's at 5%, people may tend to save more, spend less, which would help slow down the economy, which would help the Fed with the inflation, which is what their goal is. So I would tell investors today, don't expect an increase this month, but don't rule out one next month as the Fed looks at the data in these last 60 days of the year. Very volatile situation. But again, and I hate to sound like the broken record, you need to look at things on a long-term basis. And I would tell people that nothing wrong with their short-term money being at 5%, but as the market pulls back, as it has over the last couple of months since it's high during the summer. These are opportunities for long-term buyers, people who expect to have money invested 5 years or more, to be able to pick up some very good bargains in equities and think long-term. Don't be worried about what happens in the short run, because I would venture to guess, I can't predict, but I will venture to guess that over the next 5 years, the stock market on a total return basis will produce better than a 5% return. Historically, it has, and so I don't have any reason to believe that it won't continue to do that going forward.
Now, do you think the interest rates are going to affect the stock market?
Well, absolutely. As I just said, it's hard to turn down 5%. I mean, savers have been, getting zero for so long, and now seeing something at 5 is extremely attractive. And we are at 5%, and inflation running, let's say, at 3.5%. We're above break even, and for many people, even break even, after taxes. So that's a positive return, where for years we had nothing but negative returns on our savings. When inflation was running at 2% and the banks were paying 0% or 0.25%, savers were losing every year. Well, now there's at least some positive effect there. And as interest rates continue to drift up, they will compete with the stock market for that supply of money. But again, I urge long-term investors to, where they see weakness, move some of their cash, dollar cost average, into the market as you see that weakness. And I think you'll be extremely happy 5 years from now. May take a little scratching of the head and losing of some hair, which neither you or I can afford to have happen, Steve. But in the long run, the market is likely to produce a much better return than the 5% that money is earning today, both in money market funds and in the 10-year Treasury.
We just got a text message. A viewer wants to know, are you having to review portfolios a lot more often now?
The short answer is yes and no. We do have to review portfolios on a regular basis in any type of market. When a market is going up, we want to continue to look at the underlying value of the companies in which we are investing our clients' monies, and have they reached a value where we would not put more money to work in that company. And we've always said that the best time to sell a stock is when you're no longer willing to buy it, because you just don't see future value. So we're always monitoring investments. In terms of the things that are occurring today, what we're evaluating is the cash that we do have on the sidelines, that we often refer to as dry powder, is to find, just as I said earlier, when there's a pullback in the market and pullback in certain stocks that we like, that make it less expensive to buy those companies. We're a little bit more active in that regard. We are not traders. We are long-term investors. And under the Warren Buffett philosophy, if you bought a company and you bought it right, and it continued to be well managed, you never sell it. We are more what we would refer to as value managers than we are growth managers, although clearly we have some growth stocks in our portfolios. But we're looking for those companies that not only are paying good dividends, but dividends that are increasing on a regular basis over the years. Dividends have provided about a third of the total return of the stock market historically, and that's been in the 2.75% to 3% range. And so then we'd like to add 4 or 5% of growth on top of that to get a nice 8% perhaps return over a full cycle in the market or more. And so that's how we're trying to monitor the portfolios. on a regular and ongoing basis. And again, we're not traders. We're not day trading with our clients' money. We're long-term investors, and that's what I encourage our listeners to do: invest for the long term. It's hard to do day trading today and to beat the machines. So just pick good companies that have good values with good plans that have moats around them, and you should do extremely well.
What, there's many people that are having to start repaying those student loans now as of, I guess, the first of the month. What do you see as the effect it's going to have on the economy and the consumer?
Well, there's no question that after 3 years plus of not having to pay back student loans, that many who were able to save money during that period of time are now going to find that their cash flow is much tighter than it was. And as a result, one has to assume that those folks, which are numerous, some 40 million, as I recall, at the last count, and well over $1 trillion of debt, are going to have less money to spend on other discretionary items, and in some cases, it's going to put a lot of pressure on non-discretionary items, and so. The result of having to pay back is going to slow the economy down. Ironically, it's at a point where the Fed is trying to get the economy to slow down, and so it's going to have the negative effect of slowing the economy, but the positive effect of likely pulling down inflation because the consumer is going to be spending less on the want to haves and more on the need to do's.
Definitely makes sense. The Congress has appropriated all this extra money to the IRS to go after tax cheats. Who are they going to go after, and how effective have they been in collecting these unpaid taxes so far?
Well, the amount that was appropriated was some $90 billion over the next 10 years. And the service was going to use it to hire more examiners to go after those that make a significant living. And nobody's really defined what that is, but we'll just say it's people who are making $1 million or more. They have they've pounded themselves on the chest because they've gotten $30 million in taxes already in just a few months. Well, 30 million is a small return on a $90 billion investment, but in fairness, we're only in the start of it. But my sense is, first of all, I think it's important for every American to pay their fair share in taxes. And as I've said to clients over the years, I will not apologize that you're having to pay taxes on the performance of your investments. It implies you made money.
Right.
I will apologize if we're not careful in how we manage those taxes and to try to keep the taxes down as much as we can. But a lot of very wealthy people have used some very sophisticated schemes. And I don't use that word schemes in a negative sense because some of the schemes are totally legitimate, but others have a very gray area attached to them. And the service wants to go after those people. I don't think that the average taxpayer, I don't think anybody making less than $1 million a year in most cases is going to have to worry about the service coming down on them. There's a lot of rhetoric that's out there. Oh my God, look, they're trying to go after everybody to get more money. They're going to spend their time where the money is, as that famous quote goes. Why do you rob banks? Because that's where the money is. Why do they want to go after the big taxpayer? Because that's where the money is. And so that's what we're going to see. And I'm all in favor of people paying their fair share for the success that they've been able to enjoy whether it's through income or through their investments. We all should be happy to pay some degree of taxes, but again, no more than we have to pay through good management with both business and with investments.
I am really interested to know about cost of living increases in Social Security for 2024 and about the cost for Medicare. Can you touch on that?
Well, the increase for Social Security will be down dramatically from where it was last year. Last year saw either, I've forgotten whether it was either the largest or the second largest. I think it was the second largest increase that Social Security has ever had, at about 8.2%. This year, Social Security is projected to go up at about 3.1%, which is kind of confusing, given the fact that the Federal Reserve is trying to still fight, excuse me, inflation that's running at about 4% or 3.8%. So that's going to affect a lot of folks. Excuse me. As they try to prepare their budgets for next year. I will assure you that the cost of Medicare is going to go up more than 3%. There's just no question that that's not going to happen. The good news is, for those people who have Social Security and also are on Medicare, there's a cap placed on it that it can't go up any more than whatever the Social Security increase is. So that's the good news. The bad news is that means you didn't get any raise,
right?
To spend in other places. And let's face it, among the many issues that our Congress has to face, Social Security and Medicare are two of the biggest issues that they've just been kicking the can down the road on for years, and continue to do it. And the time left in which to fix things is getting shorter and shorter. Right now, the Social Security Trust Fund is expected to run out of money in about 9 years, and that means what that really means is the reserves that have built up over the years will be exhausted, and the money that they're actually collecting in Social Security to pay out will be down to about 75% of what people are receiving today. And if that happens, in order to make people whole, they would have to borrow that. The government would have to borrow that money in order to continue payments at the same level. Well, that's not good. I mean, our debt now has gotten ridiculously high, and the last thing we need to do is to make it higher. So hopefully some sanity will take place in the near future. As I was growing up young in the business, we used to say, well, Social Security will never be there when we get there. So I'm just not going to count it. Well, it is here, but it's tenuous at the moment. And we've got to find ways to fix it. And cutting benefits, not very popular. Raising taxes, not very popular. Delaying the age at which you can take Social Security, not very popular, but those are all part of what the plan has got to entail on a long-term basis. So I think most Social Security participants are going to be very disappointed this year when they get their increase and find that it's very small, if any, due to the fact that Medicare costs are likely to go up greater than what the Social Security increase is going to be. And Steve, while we're talking about Medicare, which has become very confusing for people, anybody who is 63, 64 really needs to have an independent study done for them on what is the best way to cover themselves in retirement under the Medicare plans for Part A, B, C, and D. And we have a software package to help people do that. We do not sell health insurance. We do not sell medical insurance coverage of any type. So the the work that we do is totally independent and designed to let consumers make good decisions about how to go about Medicare. And numbers scrolling across the bottom of the screen right now. Give our offices a call. Come in and take advantage of our 1-hour complimentary consultation. We can do it in one of our offices in Clearwater or Tampa, or for those outside of the Bay Area or where it's more convenient, we'll do it by Zoom to help not only with this financial question or problem, but many, many others. So please take advantage of the 1-hour complimentary consultation and just get to know us. And once you do, we hope that you'll find the independent advice that we provide is exactly what you need.
Well, we are sure lucky to have you, Ray. Let's give everybody your phone number again.
Sure. It's 727-441-9022. 727-441-9022. And
do you have a website, Ray?
We do. It's really simple. Provise.com. Provise.com. And there's all kinds of information about us and financial information that's there for people to explore and to learn. We're big into teaching people and providing the level of knowledge that people want to have around their planning. And so you'll find our website to be extremely helpful in that regard. Even if you never come in to see us, enjoy the website.
Ray, thank you so much. Ray's with us twice every month on the 9 o'clock on Monday mornings. And Ray will be back with us again. Ray, thank you so much.
Steve, take care, be well, and I'll look forward to seeing you in 2 weeks.
For sure.
Thanks.
It's Ray Ferrara. He's with Provise. They are an amazing wealth management company. And that's it for us today. We'll be back with more next Monday on Ask the Experts.
Thanks for tuning in today to the Ask the Experts show on W4CY Radio and Talk4 TV. Tune in next week and every week to hear more from our experts on personal injury, insurance, air condition repairs, estate planning, Medicare, and many other topics in the areas of legal, health, financial, and home improvement. See you next week.